Let's talk about purchasing a short-term rental property. And in today's example, we're going to use an $800,000 purchase price. Why $800,000? Because I want to take a real-world number. I want to show you why cost segregation is incredibly important. It is critical when evaluating a short-term rental investment. When purchasing an $800,000 property, don't only ask, what's my interest rate? What's my mortgage payment? And how much money do I need at closing? Those things matter. But there is a bigger question. How does this property actually work as an investment? What is the realistic revenue? What are the expenses? What does the cash flow look like? What financing strategy actually makes financial sense? Are there tax strategies you should discuss with your CPA? One of those key tax strategies is cost segregation. I am Lisa Stepp, a mortgage professional for 25 years. I have helped many investors navigate real estate financing. Getting a mortgage is only one piece of the deal. I help short-term rental investors understand the whole deal. Let's break down cost segregation in plain English today. What is it, and why do investors use it? Why is it particularly interesting to investors right now? What questions should you ask your CPA before buying? Please note that I am not a CPA or tax advisor. This video is for educational purposes only. Your tax situation must be reviewed by your CPA. My job is to make sure you ask the right questions. Let's start with the basics of cost segregation. Residential rental property is normally depreciated over 27.5 years, but a short-term rental is more than walls and a roof. Think about all the assets included in the purchase. You have appliances, flooring, furniture, cabinetry, and lighting. There are also outdoor improvements, landscaping, and fencing. These different pieces of the property have different useful lives. That is where a cost segregation study comes in. The study takes your property apart for tax purposes. It identifies components qualifying for much shorter depreciation periods. These periods can be 5, 7, or 15 years. This is much faster than 27.5 years. Now, let's use our $800,000 purchase price example. Assume that $120,000 is allocated to the land. This leaves us with $680,000 of depreciable basis. Standard depreciation keeps most of this in 27.5 years. But a cost segregation professional analyzes the property. Assume the study classifies 25% as shorter life. 25% of $680,000 is $170,000. Please remember that results vary for every property. One property might produce a higher or lower percentage. We use $170,000 simply to show how it works. Current tax law provides 100% bonus depreciation. This applies to qualifying property bought after the 19th of January 2025. It includes property with a recovery period under 20 years. Our identified $170,000 of assets could qualify. Qualifying portions are eligible for accelerated first-year depreciation. This moves significant depreciation deductions into the first year. Cost segregation changes the timing of your depreciation. You are legitimately taking more of the benefit sooner. A $170,000 deduction is not a direct check. A tax deduction simply reduces your taxable income. Suppose the investor is in a 32% bracket. 32% of $170,000 is approximately $54,400. That is why investors investigate cost segregation strategies. Your tax situation must be reviewed by your CPA. My job is to make sure you ask the right questions. Your actual tax benefit depends on many individual factors. Most importantly, it depends on passive activity rules. Short-term rentals have special passive activity rules. An exception exists if the average guest stay is short. The stay must average 7 days or less. Average means your tax professional must calculate actual stays. Next, do you materially participate in the activity? Material participation is evaluated using specific IRS tests. One test requires participating for more than 500 hours. Another test is met if you do substantially everything, or you participate for more than 100 hours, and you participate more than anyone else does. Your CPA must determine which test applies to you. If material participation is key, documentation is critical. You must track and substantiate all your hours. Track managing, coordinating guests, and handling vendors. Work with your CPA on what records to keep. The real question is, can you use the deduction? High-income professionals can benefit significantly from this strategy. If you qualify, the resulting loss can be non-passive. But do not buy a bad property for tax deductions. The investment itself must make solid financial sense. What is the realistic occupancy and nightly rate? What are the management, tax, and insurance costs? What about cleaning, maintenance, repairs, and reserves? Then evaluate the financing terms and debt payments. What happens if the property underperforms your projections? A tax strategy cannot make a bad investment good. Remember that depreciation recaptures when you eventually sell. This must be part of your long-term plan. Ask your CPA, does cost segregation make sense? Ask, how does average stay affect tax treatment? Ask, would I meet material participation requirements? Ask, what records should I track this year? Ask, are there recapture consequences when I sell? Once tax is planned, let us structure financing. We can evaluate DSCR, conventional, or LLC options. Let us make sure the investment makes financial sense. Build the strategy and bring the right team together. Visit lisastep.com to evaluate your next property. We can look at the numbers and financing options. I want to help you become a better investor. Thank you for watching, and see you next time. This information is for educational purposes only. Consult a qualified tax professional for personal advice.